everybody, my name's Alba, as you knew by my title, with Moses Lake Realty Group, and today we have Kelly Price here, and we are here to explain everything you need to know about loan programs. So in December, I got a lot of calls of people wanting to buy a house this year, and I can explain as much as I can and know, but there's nothing like having the professional here to go through every single loan option and what that all means, because I know a lot of you have questions, and if buying a house in 2021 is part of your process, then we're here to help, and I'll let Kelly take over and start. So one of the things is there's how many different loan programs that exist or that you
so
offer.
many.
Yeah.
So that's the wonderful thing about being able to work with people, is that you get to figure out which loan program fits for each person, because there's not one size fits all loan program. It depends on so many different factors. So it could be your credit score, it can be your debt to income, it can be sometimes even employment history. There's so many things that fit into, or even how much money you make. Some of these programs have income limits to it, and it's just it's really cool to be able to sit down with somebody and figure out what program fits them best and what's going to help them in the long term. And I love that. That's the best part.
Dissecting every case is different. Yeah.
No loan is ever the same. Not one. You don't ever have one where you're like, I mean, it's just so interesting. Like every day I feel like it's something new, and not in the bad way. It keeps you like on your toes. It keeps it exciting.
Right. Something always comes up, right?
Yes.
Oh, so on that note, we're going to also do a second video of what not to do.
Yes. Because it's surprising. Things you wouldn't think could affect your approval process can.
Yeah.
So that's going to be a good video.
So, that's going to be fun. So the very first loan program, you would say the most common? So is there between two of them, or? Yeah, so in our area, we're very lucky to be in what's considered a rural area. So we do a lot of USDA loans. So, I mean, if you live in a bigger, more populated area, like even, Tri-Cities, Spokane, like Seattle, these USDA loans, you can't do them because you don't live in the right area. And USDA, of course, has specific guidelines, like with their debt to income, credit scores, income limit is the big thing. Mm-hmm. That's the big thing. And that program is great. So we do a lot of USDA, and we do a lot of FHA loans too. And they don't care where you live per se with FHA. It's just they're a lot more flexible than maybe some of the other loan programs. Like there's conventional financing too, but a lot of times they want like higher credit scores, a down payment. The FHA program is a government program, and so there's even some assistance with down payment if you need it. That USDA loan, the rural one I was talking about, is a zero down program, which is so nice for people, because when you're moving into a home, it's expensive, right? Yeah. Not everybody can afford to come up with that much money. Right. Your down payment, your earnest money, your inspection costs, and then your move-in costs.
Closing costs, if the seller doesn't pay for those. I mean, there's so many things. Or if a house needs a fence or it needs something fixed in it. I mean, there can be so many reasons why you might need a little bit of assistance there. Right. But FHA is also great. Even if you want to put a down payment down, their requirement is only 3.5% down. Right. So it's a lot less than some of these other loan programs can be, which is awesome.
And a lot of people get the misconception that you need 20% to buy a house.
Correct.
You don't. Yeah. You don't. There are programs out there, even zero down, that you might qualify for.
Yeah, that is, I do hear that a lot, where people are worried when they talk to me that they don't have 20% down, and they're often pleasantly surprised that there's some great options. Now, obviously, if you do have 20% down, that's awesome.
Even better.
That's great. Right. But there are a lot of options for you if you don't have that. And if you're a veteran, that's a program we haven't talked about. If you're a veteran, if you've served in the armed forces, or you're currently serving in it currently, that's a zero down program, and there's no monthly mortgage insurance, which is very nice. Cool, and it's it's a very affordable loan. So I always ask people, like, have you ever served? And obviously, thank you if you have. So VA loans are some of my favorites.
Oh man, and the stories they have.
Yes,
I love VA buyers. So then, the makeup of the USDA loan. Who would be an ideal candidate for that loan?
Yes, good question. So USDA, first and foremost, is very strict when it comes to the income limit in our area. So we're still waiting for 2021 numbers. It can sometimes take a couple months, sometimes even a few months before we find out what their 2021 income limits are. In our area, for families so if there's 4 people or less living in a household, it's just over 90,000.
Okay.
But if you have, like, let's say you're a single parent with 4 kids, or you're a married couple with 3 kids, the cap is actually, and all those people live in the home, the cap is closer to 115,000. So it goes up a little bit if you have more family members.
Under 115, 0 down. And does that have...
With the big family. So a lot of times I find people, though, it's usually like, I find a lot of families are 4 people or less. So it's like, it's just over 90,000. And that's the hard part, because they'll go off of your projected income a lot of times. Like, oh, you have the potential to make this much money. And so they're really strict on it. Even if we don't qualify you on it, USDA's really strict. And the reason why is because USDA has fantastic interest rates. They have fantastic mortgage insurance rates, which is the other thing. It's like a third almost of what other programs can be.
Wow.
And low upfront fees. So USDA loans are really great in a lot of cool ways. And I think because of that, they can be a little bit strict. They're trying to make sure it truly goes to the families in need for that program.
Right. I love that. So what does USDA stand for?
It's USDA. It's the U.S. Department of Agriculture.
Oh, she nailed that.
Yeah. So and it's interesting because there's 2 types of the USDA loans, but the ones that we deal with primarily in this area are going to be the ones that deal with us.
The rural.
Instead of the direct ones.
With that word.
Rural. It's
rural.
That's a weird word.
Rural. Got it. Alrighty. So then USDA, what I got from it, there's an income limit, better mortgage insurance rates. And how about credit score? What would you think would be a safe credit score to even think
So
about?
It depends on your lender. I work for Guild Mortgage here in Moses Lake, and Guild Mortgage's minimum credit score requirement is actually a 600.
Okay.
So if you have a 600, now they want other what they call compensating factors. So they'll want to see that your debt to income, so your monthly obligations compared to the income you bring in, they want to see that that's lower. And they sometimes like to see like your rental history. They a lot of times will want to see that you have extra money in savings, whether it's 401k in your checking and savings account.
Money for reserves.
Yeah, what they call reserves, exactly. So they'll want to see like, okay, if something happens, you have something to tap into. So, but that is a really cool thing. They're pretty forgiving when it comes to credit scores, and their interest rates are really great on that program.
So this is definitely a good program. There are some stricter requirements, but you can get the opportunity to come in with 0 down.
Absolutely.
So now, it's good to ask.
Let's say you don't fit into those categories, and that's okay because there's other loan programs. There's the FHA loan, which has...
Let's talk FHA.
Yeah, okay. I love FHA. So that's a great one. And actually, a personal anecdote here. My first home loan, I bought my first house in 2009, and it was with an FHA loan. I wasn't... I had a cosigner and everything. Like, I wasn't like your typical, like, perfect first-time home buyer. I'm a good example of that.
I love that you mentioned that because it's true. We work in this industry, but we were where you were at one point. I know my first loan was FHA too.
Yeah.
We were the best. Our debt to income was really high.
They are so much more flexible on that. They're like the most flexible, and on credit scores and
Yeah. So it's a blessing. You guys don't ever feel like you need to be perfect to buy a house. You need to have everything straight. You'll work your way towards there and towards that. Yeah. And especially as you learn and as you get into these loan programs and people who help you, they give you so much information that will help you in the long run. Yeah. So what is the makeup of FHA?
So FHA has a minimum, and actually we can go down to a 600 credit score on that too.
Okay.
And keep in mind, different lenders will have different overlays. Some can't go down that low. Some have different overlays where they want a 620 or a 640 credit score.
I've heard 640, yeah.
Okay. On a lot of them. So Guild is really flexible. Okay. I love that. Just a little plug-in for my company. But so they have a down payment requirement of 3.5% down, which is really great. If you're not able to come up, like we've talked about, some of those bigger down payments, and you have a better, like if again, this is like more with my company that I work for, but you can have a lot better interest rate because we have down payment assistance too. So Washington State has a program where you can borrow your down payment. And that's a great program too. Like if you truly need like a 0 down program, but they have a little bit higher fees and they have a little bit higher interest rate. But that's a good option. But if you have your own down payment, you can get a really, really, really good interest rate with that too.
So, for example, let's say you're buying a house for $250,000. Mm-hmm. And 3.5% of that, you're looking at coming in with a down payment of $8,750.
Yep.
So just to get an idea there.
Tax return season is just around the corner, and keep in mind your tax refund can actually be used towards a down payment.
Yes, exactly.
Which is so cool. I love this time of year, you know, because sometimes, you know, you just get done with the holidays, and I mean, shoot, we just had 2020, the craziest year, you know, and not everybody has that money available, and sometimes people actually end up, if they've got, you know, families especially, you know, end up with pretty good tax refunds, and you can absolutely use that as a down payment.
You can boost yourself so much with your down payment. Don't buy a car. They're only going to depreciate in value unless if you don't need one, don't buy one. But yeah, definitely. Mm-hmm. So can you explain a little bit about the down payment assistance? So there is a program where the government, so FHA is a government-based loan.
Yes, it is. So is USDA.
And it stands for?
The Federal Housing Agency.
So with FHA, there's a the government lets you borrow your down payment, but there's also the other portion that it can be 100% a gift and you don't have to pay back?
Yeah, so if you have a family member that's willing to gift you a down payment, that's a way that you can do it. And of course, if that's not an option, you can do the down payment assistance program. They have an income limit too, but theirs is a lot higher. Theirs is $145,000, so it's a lot higher for you. And they're not as strict, like they don't do like projected income like USDA does. I mean, they go based off of what you're qualifying with.
Okay.
Which is really great.
Okay.
But yeah, FHA has options. So like, let's say also that you don't have someone that could gift it. You don't really want to do the down payment assistance program. And you can also borrow from your 401k if you have that. That's an option. You don't have to take a withdrawal. Per se, you can do a loan and then basically you pay yourself back with the loan. So that's an option with a lot of 401ks. Sometimes if you work for the state and some of those other types of like their retirement programs, not all of them will let you do that, but a lot will.
Yeah.
So that's an option too.
That's a good point. So then would you say, so for FHA, 600 plus credit score, you'd come in at least with 3.5% down. There is some down payment assistance. And like she said, it does include some higher rate.
Yep, the rate's a little bit higher, and the closing costs are.
Very flexible option for those that maybe their debt to income, their credit score, things like that. So would you say...
So the down payment assistance actually has a minimum credit score requirement. That's the other thing, of 620.
Okay.
So that's something to keep in mind too. And that's a nice thing. So like, when, for anyone watching this video, if we sit down and we talk about your different loan options, we figure out which one of these suits you, so don't feel like you need to be like taking frantic notes and figuring it all out, like that's part of what we're here for.
Even though that's something I would do when I watch YouTube videos, that's like my notebook. Like, I'm an expert and I know what I'm here for. No, kidding.
Which that's okay too, to be educated and come here, and have that conversation. So that's all right too.
So would you consider FHA the most flexible option of the loan types?
If you have your own down payment, because if you do down payment assistance, there's a restriction on debt to income. But if you have your own down payment, yes. I would say it's the most flexible. And not everybody's going to fit these two loan products. Like, let's say you are someone with a lot higher of a credit score. You have a down payment. Like, conventional loans is another type of loan. That's not a government loan. And that's actually as low as 3%, but you're going to end up with a higher rate and higher monthly mortgage insurance. If you can, you can also do in increments. You can do 5% down, 10% down, 15% down. On that loan type, you don't need to have 20% down. And sometimes it makes a lot more sense for someone to go conventional versus FHA or USDA. It just depends on quite a few factors there, but conventional loans can be great. And they have some affordable loan programs there too. Like there's income caps in our area. They just raised it. It's like $59,000. Like if you make like $59,000. So if it's just like one person on the loan, sometimes that's a really good option. And they've got some breaks for you when it comes to the monthly mortgage insurance rate and the interest rate. So,
okay.
Yeah. So with all of these, it just goes to show, like, depending on where you fit, there are just so many options for you, which is really great.
Yeah, definitely. So conventional, how much of a down payment?
Technically 3%. Technically 3%. But the thing is that depending on the program, a lot of them require at least one borrower to be a first-time home buyer.
Okay.
That's the only one, you guys. Isn't that crazy? Everyone thinks like USDA, FHA, you have to be a first-time home buyer. You don't to get into those programs. Okay. So not all conventional 3% down require you to be a first-time home buyer, but a lot of those programs, yes.
Okay.
Isn't that interesting?
And this class, they can do it online.
Yes.
Right. Especially now with COVID.
Talking about the down payment assistance one? Or which one?
No. You said first-time home buyer, and then they have to take a first-time home buyer class,
They do, and
right?
you can take it online, yes. Yeah. But that's interesting. So, again, there are some programs where you can do 3% down and not be a first-time home buyer. Mm-hmm. But, it's just, it's always interesting to me because that's a very common misconception. A lot of people feel like if you're a first-time home buyer, that there's certain programs dedicated only to those, and that's not the case. Yes. The USDA and FHA program, they obviously don't want you to have like multiple of those loans at one time.
Right.
But if you've bought a house before, you can still get into those as long as you fit in their parameters.
Yeah.
Which is cool. Yeah. But conventional is great, there's monthly mortgage insurance on all of these loans unless you're a veteran. Mm-hmm. And monthly mortgage insurance, that's one thing to know about the government loans, like the USDA and FHA. It's the life of the loan, where unless you put like 10% down on FHA, then that changes it.
But I like that you mentioned that. Yeah.
Yes, and that's the one thing that's really nice about conventional loans, and they are a little bit more strict on the debt to income, and a lot of times they like to see some of the higher credit scores. But I mean, and technically you can go down to a 620 on a conventional. Okay. It doesn't always work. They seem to be a little bit more strict, but depending on what they call the compensating factors, if you've got, some other things that are supporting with your application, sometimes that can work. But
everything aligns. Mm-hmm. So with a conventional, your private mortgage insurance falls off after you've paid how much percent?
See, they've got a really funky rule. So it's 78%. Unless, so once you paid it down to a 78% loan to value, unless, because technically you hear the 20% once you hit 80, the monthly mortgage insurance doesn't fall off on its own until 78%. But when you hit 80, you can call, like for example, we keep most of our loans, so you just would have to call me and be like, Kelly, I paid it down to 80%, can you let's get a letter sent so we can drop this, or else it's going to stay for an extra little bit.
Yeah,
so
and it could save you about 100 to...
depending on what it is, depending on, because conventional, it depends on your credit score, it depends on your loan to value, on where your rate is for the monthly mortgage insurance. If you get a government loan like USDA, FHA, it's a set rate.
It's set rate.
No matter, on the mortgage insurance, no matter what your score is. So that's one thing with conventional. Again, it's sometimes it makes a lot of sense to go conventional, sometimes it doesn't.
Mm-hmm. So if you're watching this and you have a conventional loan, talk to your lender. You might be able to have that fall off and you save some money on your down payment. Your monthly payment. Yeah. There was a question I had. Can you explain, what was it? Hold on. Oh, I lost it. I had a question about, it's on the tip of my tongue. Okay. Let's go VA and maybe I'll remember.
Okay, works for me.
Yeah, totally left the building.
It happens. It's early in the morning. It's okay. So,
coffee.
So VA loans, I love those. First off, to be able to help a veteran or someone who's currently serving in the armed forces, I feel is such an honor, right? Because they've done so much for us. So I love that. And VA is great because they don't require a down payment. It's zero down, and they don't have monthly mortgage insurance. So there's some really great benefits, and they're pretty flexible. So also has the lower credit score requirement, and it's great even if you have an 800 credit score. I mean, VA loans are amazing. I love to help them. So
it came back to me.
Okay.
Can you explain why buyers have to pay mortgage insurance? What is it for? They're already paying home insurance. They're already paying their car insurance, their health insurance. What exactly does mortgage insurance cover, and why do they have to pay it?
So that is a very good question. So what I always try to explain to people, because mortgage insurance is like, you hear about it, but you don't really know what it's for, right? So mortgage insurance, I always explain it as like, mortgage insurance is there unless, so if you put 20% down on a conventional loan, you do not have to pay monthly mortgage insurance. But mortgage insurance, I always tell people like, if you're doing less than 20% down payment, you're considered, not that you're risky, so take this with a grain of salt when I say this, but like you're considered like a riskier, I don't want to say that, that's a bad word. I feel like it's like.
You can call me risky.
But the way they look at it is if it's, you know, the loan itself can carry a greater risk.
Listen, the bank goes off of numbers and calculations.
Not you as a person.
Yeah, not you as a personal. Yeah, it's all on their formulas and they're at risk. So at that
exactly. So it's it puts them in a different risk class, I should say. So I always tell people, like, mortgage insurance is there because these people that are issuing these home loans, USDA, FHA, conventional, they're investing in you. Just like you're investing in yourself, they also invest in you. Right. So it's basically the investors' way of protecting their investment in you, if that makes any sense. So it is a very small percentage of home loans that end up defaulting. And so they have to be able to have some type of reserve on their own. And of course they don't want you, and please do everything you can. It's amazing what kind of services there are out there to prevent you from going into foreclosure. There are some great programs out there. So if you run into a hard part in your life, like, do everything you can to prevent a foreclosure, because it can really hurt your credit, like, a lot. And there's a lot of, like, guidelines out there and waiting periods and everything else. And the foreclosure part. So they want you to just be, again, it protects the investor's investment in you. So that's why they make you pay it.
In case you were to default on your loan, this mortgage insurance will cover
that. But it doesn't cover you. So it's not one of those. It protects the investor. So basically, think of it this way. So, like, if you run into a hard month and you're like, I can't pay my mortgage this month, you can't say, oh, I have mortgage insurance to cover that. It does not work that way. So it's there to protect the investor, but it also allows them to continue to issue these home loans. Right,
and give people that opportunity, because in the end they're fronting the money, you're paying it back. So that leads me to, I have a lot of buyers saying, some of them get really impatient when it comes to the offer process. So they're like, why did they take this why did they take the cash offer? I'm coming in cash too. It's like, well, you are coming in cash, but you're getting financing. So there's a process, and there's still steps you need to take to get your loan, and that's not 100% compared to someone wiring
plus funds. An appraisal.
And the appraisal is part of the process. So there's definitely a difference. Just like if you were an investor, you would like to cover your end. For the most part, these are amazing programs, and there are a lot of them that you could fit in, even if you think you're a non-traditional buyer. There's so much opportunity there.
And actually, there are some opportunities if, let's say you're, like, maybe you're a Dave Ramsey fan, I don't know, and you don't have a credit score, right? There are options to still buy a home. It's definitely not as easy, but there are some options if you don't have a credit score. But there's a lot more that goes into it. Yes, so just keep that in mind. It is easier if you have a credit score. But it's not impossible. You know, if you are someone that does not have credit, I have been able to do home loans for people with no credit score.
Okay, wow. So that would be interesting to look into.
But again, I won't even get into it because there's like a whole bunch of stuff you got to do to make that happen.
I am sure there is. Awesome. So if you guys have any questions, please feel free to reach out to me and Kelly. I feel sometimes like I should be able to do more for my clients. I'll get calls and it's like, I want to buy a house. What do I do? Where do I go? And then I send them off. But it's like, I'm not just sending you off to anyone. Like, I'll refer you to Kelly or other people that I trust, and just know you will get taken care of. We're here to help you. We're here to guide you. You shouldn't feel embarrassed or shy or whatever it is asking questions. And if you need us, we're here. We are here. We will link all our information down below.
Absolutely.
Is there anything that we're missing or that you wanted to add?
No, I think we covered a lot of it. Just know that we just skimmed the surface today. You know, I mean, we could make this a lot longer video. We don't want to do that, of course, but but there's a lot that goes into it, and it is an honor for, Alma and I to be able to help people.
Definitely.
It doesn't matter how big or small your transaction is, and it is such an honor to be a part of that. You're making one of the biggest financial decisions of your life, and to be a part of that and help guide you through that. I keep saying that, but it truly is an honor. It's so special to be a part of that.
This can completely change your life, honestly. Purchasing a house. It's the only, I would say, investment that pays you back if you take care of it. If you take care of it, as the years go by, you're making money when you sleep, and you'll have something to leave your children with. It improves your credit. If you take care of your loan process, your home, you're good.
Absolutely.
Oh, one more thing before we leave.
Yes.
okay, let's say someone wants to apply. What do you need from them initially?
Oh, that's a great question. Yeah. So there are a couple of different ways that we can apply with COVID going on right now. I'm primarily doing everything either over the phone, and I'm doing a lot of online applications as well. So I can send you a link to apply, and then you can enter your information, and then I do call and do a follow-up, and I go, verify everything that's in there, and then we go through your whole application. But Guild has some great technology, so you can securely upload your documents. We have some great online portals that are completely secure that you can upload your stuff. But important documentation is your last 2 years of W-2s, your last 2 years of tax returns, your last 2 current pay stubs, so a lot of twos here. And then and I like to take a look at bank statements too, like the last 2 months of bank statements. Even if you don't need a down payment, oftentimes we still have to verify with a bank statement of some kind. So it's just great to be able to verify that with the documentation and, verify everything that was entered into the application.
So on that note, stay tuned for what not to do.
Yes.
When buying a house.
Part 2.
Yeah. So. That's going to be fun. Thank you all for joining us and for watching. Make sure you hit that like button. I sound totally YouTuber, but here we go.
That's all right. It
very
works.
helpful. Please do. And again, if you need us, we're here for you.
Absolutely.
Have a good one.
Bye.
The purpose of each. So that's what we're going to go over. Oh, it's always nerve-wracking.
I'm a ham. I like to be in front of the camera. So.
Alrighty. And I'm going to crop everything we talked about before this.
Oh, okay.
Wait, my dishwasher's singing.
My appliance is singing to me too. Isn't that the funniest thing? That's funny. Yours sings longer than mine though.
Yeah, I know. It's like has a full orchestra moment there.